to the extent that there are ways to diversify the portfolio, ways to make sure that you're creating a long-term program, you're investing programmatically versus simply cherry picking and hoping for the best. There's no average in venture. Well, there is average in venture. You don't want average in venture.
You do not want average in venture.
Average in venture is terrible.
Hi, this is Matt Pelker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of The Investment Office. We took a brief hiatus over the holidays, but excited to be back at it here in 2026. As always in The Investment Office, we're here to discuss the latest in institutional investing, alternative assets, and private markets. This week, I thought we would start by talking a bit about probably the biggest news in private markets over the last week, which was the acquisition of Brex by Capital One for just north of $5 billion. As a little background, Brex is a fintech platform, probably best known for their credit card product for startups. They were one of the earliest companies to start offering credit cards to companies that traditionally wouldn't have qualified for more classic credit card options like American Express. There are now a number of players, but Brex was really probably one of the first here, and then they, beyond that product, diversified into a broader range of fintech offerings, including banking and accounting. The acquisition was certainly interesting because of the top line number. $5 billion is a lot of money. But it was also interesting because the financing history of Brex has taken it on quite a journey. Brex's first round, their Series A, was back in 2017, and their most recent round of financing was in 2022. And in fact, the most recent round of financing was done well north of that $5 billion mark. The Series D extension led by Green Oaks in 2022 was done north of $12 billion. And so there's been a lot written about what that means in terms of outcomes for various parties on the cap table. And so, maybe first, Wendy, just wanted to get your top line thoughts on this acquisition, and then maybe dive into some of the details around kind of how various parties between the founders, the investors, the LPs, kind of how they probably thought about this acquisition.
I think top line reaction, anytime you hear about a company that has built $5 billion in value for its early investors, its founders, it's hard not to look at that and say this was an enormous success, an enormous company, an enormous outcome that was built that started in, as you mentioned, I think the first round of funding was back in 2017. So in less than 10 years, $5 billion of value was created and built. And I think in any number of measures, you might look at that and say, that's a really successful outcome. Now, of course, as you alluded to, it really does depend at what point an investor came into this business, at what point did an investor join the cap table, because depending on the valuation that was struck for that investor, to your point, the later investors may have had a very different outcome. And so I think one of the things that I'm excited for us to dive into is just when folks think about venture investing, I think if you're not in the day-to-day business of institutional investing in private markets, if you're not in the day-to-day business of investing into venture capital or growth equity or private equity, venture capital might just be a catch-all umbrella, but it actually has enormously varied parts of the ecosystem. Depending on which part of the market an investor might participate in, there are vastly different expectations in terms of risk and outcome and different ways of underwriting and different ways of considering what could be a reasonable set of expectations for those investments. And so that'll be, I think, something for us to dive into a little bit here. But before we go there, Matt, I think it'd be really interesting for you to walk us through the financing history of Brex.
Yeah, and it was, I think probably not a dissimilar journey for a lot of companies of kind of their era and of the growth that they experienced over some of the key years. And so this is data that somebody had sourced from Caplight. So caveats here being that, of course, this may differ from reality in various ways, but it looks certainly directionally correct to me. So
okay, just pause for a second. What is Caplight?
So Caplight is a data provider. They have lots of interesting data on cap tables, on who's invested and at what, how much they invested, at what price, often they have information on the terms of those investments, things like liquidation preferences. And so when an acquisition like this happens, it's a good view into who's actually making money and how much money are they making. Because again, in situations like Brex's, where there was capital raised in the private markets, often below where the eventual liquidity event happens, the how much money people are making can end up changing a lot based on where they sit in that capital stack and the dilution and so forth. And so, when you look at their first kind of institutional round of financing was done, like we mentioned, in 2017. That was led by Ribbit Capital, which is one of the better known kind of historically fintech focused early stage funds. And that round was $7 million at a post money valuation of $22 million. So the company gave about a third of the business at that point for $7 million, which is certainly a meaningful amount of dilution for the founders. But obviously, given a $22 million post money valuation, those investors, Ribbit Capital and others who participated in that round, made a lot of money in this acquisition. Mm-hmm. And then, as you look through, their next round was done at a $220 million valuation, 10x over that. But again, still folks making a lot of money. And then things start to get into the billions of dollars. And 2021, which is their kind of the first part of their Series D, Tiger Global was the lead on that. And I think there was a lot written about Tiger Global, who was very active in that period, and I think was notable for investing huge sums of money, often with perhaps less diligence than would have been traditional at those stages. And for the check sizes they were writing, they were making huge bets on companies, and that was done at a $7.4 billion valuation. And then, as I mentioned, the last round, which was led by Green Oaks, who again is one of these firms, to your point, Wendy, maybe not even somebody would have traditionally thought of as a venture fund in a lot of ways, and did that at a $12.3 billion valuation. And now both of those firms made their money back, right? Because typically the way these venture financings are structured is that if a acquisition or liquidity event happens below the valuation which you invested, you get your money back first. And so they made their money back. But again, no one's looking certainly in venture, I think, even late stage venture, to just get their money back. That's not, I think, necessarily a great outcome. And so I think it really, this is a kind of a terrific example of perhaps some of the frothiness that existed in late stage fintech in particular, in that kind of post-COVID ZERP era, where money seemed it seemed like money was growing on trees, I think, in some ways in that era.
It's funny because we're not that far removed in terms of time frame, but we are so far removed from that era in terms of discipline and underwriting and cost of capital, right? And I think this will be the first of what I think will be many companies that perhaps we'll hear more about, where there was capital raised at 2021, 2022 valuations, and where there are still going to be big outcomes, and it will be a big win for earlier investors who invested at lower valuations, but maybe not as much for investors who are coming in during the highest points of valuation. Probably a lot of different topics and different avenues that we could go down on this particular example, but I think it speaks to, just from an LP standpoint, I think about when you're investing into venture, and I talked about if you're not doing this day to day, venture might just be in your mind one big umbrella term, but venture really is an amalgamation of various stages of risk taking. At the earliest stages, early stage venture, you're really looking, VC firms and LPs investing in those early stage VC firms are really looking for outlier winners, right? There's almost not you stick your finger up in the air and pick a valuation, but to some degree, these valuations don't necessarily correspond to any other meaningful economic indicators of these companies. There's just almost sort of like agreed upon, this is sort of the valuation at this stage for this type of company. And so you have what are, in some instances, just kind of made up valuations for these very early stage companies, because really what an early stage VC investor is looking to do is to take a, let's call it, meaningful ownership percentage of that company, and across a fund take enough ownership positions in enough companies that one of those companies might turn into a Brex, right? You might have this outlier winner that's going to produce 100x returns, 1,000x returns for the fund on that single investment, which will then, over the value of the entire fund, return a good, called fund returning investment for all the LPs. And that's early stage investing, right? We're talking about, really, it's about finding outlier winners. It's about taking enough ownership concentration for it to matter into a GP's portfolio. And LPs are investing knowing that that is going to be the distribution of outcomes in early stage ventures, going to be a fair number of zeros, maybe some that simply return an investment, but ideally in a great fund, the reason everybody is investing in an early stage venture is that there will be these outlier winners that are going to end up allowing the fund in total to return, let's call it 3x net, 4x net, whatever, etc., right? Higher, ideally. That's early stage venture, but I think what folks don't necessarily always realize when we talk about these types of investments like Brex is that as the investments go into the later stages, the underwriting becomes really different, and all of a sudden valuation discipline, which I think doesn't often necessarily get associated with venture, all of a sudden valuation discipline really does matter, right? And so that's where we have, I think, the experience that you're describing here for certain later stage investors that lost valuation discipline, where at the end of the day, these are still private companies. There need to be realizations and outcomes, and because there still is this illiquidity aspect to these companies, there is still this higher degree of risk than, say, public market companies, where you can, on a daily basis, see what the market agrees is the fair value for these companies. With private market companies at these later stages, valuation discipline is a real thing, and getting those valuations right does matter in the long term, because ultimately at some point there needs to be an exit, there needs to be a broader agreement from either a buyer, in this case Capital One, or should a company ever IPO, there needs to be agreement from market participants on what the fair value of this company is at the time of exit, right? So I think oftentimes where venture is thought of as sort of an umbrella term, it actually does have these nuances depending on what part of the venture ecosystem an investor is participating in.
Well, and I imagine also the timing considerations here are so different, right? In the sense of, if you're an early stage investor, an early stage venture firm, the expectation is that the timeline to exit is extended, and you probably have the benefit as an early stage investor of in some sense waiting out bad periods or rougher periods in the markets. Whereas, to your point, these later stage investors, I assume from an LP's perspective, I assume like just the expectation on time to return of capital is shorter, and so probably it compounds the difficulty I would expect there in terms of being valuation sensitive.
Yeah, I think there's two parts of it. There's the timing piece, and then there's also the overall risk underwriting to return expectation that is going to be different for when LPs look at early stage versus later stage, right? The idea is you're expecting your later stage investors, your later stage GPs, to be far more accurate in their judgment of which are the companies to be investing into. These are still, of course, they're still unknowns. These are still growing companies. They're not necessarily mature. They're still fast-growing companies, right? And so there's still uncertainty in their ultimate outcome. But the range of outcomes, that degree of uncertainty, should be significantly less and significantly reduced versus early-stage investors. And so I think for later-stage investors, part of it is the structuring that you referred to, where those dollars in are going to have certain structuring terms that allow for, at least at a minimum, return of capital. But the overall expectation is that the returns there are going to be more bounded, but also, to your point, there is a higher expectation of a reasonable return within a reasonable time frame. So I think, to your point, there may be some greater degree of expectation to liquidity, some expectation to liquidity that is going to certainly be shorter than the 10 plus years that I think early stage venture firms are afforded. It's a separate conversation about whether or not investors actually realize that for early stage, even because I think there's pressure even on early stage venture firms to show distributions before that 10-year time frame. There, you might still have investors who are expecting earlier distributions, but I would say that's more of perhaps a misunderstanding on the part of the investor who is maybe less familiar with what the typical time frame to liquidity is. But certainly for later stage, I think it's reasonable for investors to say, okay, well, I'm not really in this for a 10-year time frame. I'm also not in this for the same wide dispersion of outcomes that you would see in early stage venture, right? And so the bounds of expectations are going to be a little bit tighter. And so I think you're right. Like there's going to be a little bit more pressure on those managers. The other thing that I think is really important that this raises is this idea of vintage year outcomes, right? We sort of touched on it, but I think if we were to just put a finer point on it, it's this concept of vintage year diversification is important in every area of private markets, but certainly in venture, vintage year diversification is important, and vintage year outcomes have made funds and firms and venture investors look like geniuses in certain periods, right? And then I think, let's call it 2020, 2021 funds, maybe even 2022 funds are perhaps not going to be the best vintages in venture. And so if that was, as an LP, that was the first time you were getting to venture and you were getting into it in a big way and you did not necessarily continue to invest into venture now into 2023, 2024, 25, now 26 vintages, it is going to be a challenge, I think, to ever say that you're going to have a successful venture portfolio if you're not creating this vintage year diversification. Because again, outcomes in venture can be very cyclical, as in all private markets. It just, like everything else in venture, is just so much more pronounced. The highs, the lows, the concentration of successes in certain years. Going back to 2020 and 2021, those were great years to be sellers of assets. I recall certain GPs in closed door panels saying they were literally trying to sell everything that wasn't nailed down to the floor, right? So if you were in earlier vintage year VC funds where some companies were ripe and ready for exit in 2020, 2021, those were great exit years. And so you had some vintage years that really benefited from those peak valuation periods.
Yeah, I mean, it feels like the vintage year diversification is important at both ends of this venture spectrum we've been talking about, right? Like certainly at the late stage, obviously, folks who were deploying big capital in these frothy years, that's gonna be problematic. But then to your point, at the earliest stages, while the timing may be less of a challenge because you have perhaps a longer horizon, to your point, early stage venture is so driven by outlier outcomes that even the firms that are consistently, let's say, top quartile, it's hard to pick the vintage that's top decile, and you probably have to be consistently investing in the great managers to find those truly outlier funds.
Correct. Absolutely. Certain vintages are going to drive an entire venture program's returns. And it can be extremely concentrated and narrow in which vintages that occurs. And missing those vintages, even if you weren't invested in, say, the best venture manager, if you had good enough venture managers in those vintages, you probably still got some really great outcomes, right? You might still have overall a great venture program return. Certainly if you were in the top decile of VC managers in those best vintages, you're going to have returns that justify a VC program. I'll put it that way, right? A VC program can be hard to justify if you're not in the top decile managers and also capturing those best vintage year returns. If you're cherry picking, and there are investors who I think have negative experience with the venture, in part because And it makes sense. Folks are drawn into venture in years like 2020, 2021, where valuations are running high, where venture is generating big outcomes for folks who had been invested in earlier years, earlier vintages, right? But as an investor, a new investor to venture, if what you're seeing is the froth of 2021 and you're experiencing the FOMO and entering into venture in those years, and those are the vintage years that you're experiencing, then there's going to be some disappointing outcomes if, again, the decision was to cherry pick and enter venture when it looked most, at the time, hyped versus creating a longer term venture program that's investing across vintage years and is thinking about success over, again, a longer period.
Well, I was going to say, and tying it back, I think, to another topic that we often talk about here, which is, broadly the democratization of private markets and opening private markets up to a wider variety of in particular, retail investors. It feels like this is an asset class, to your point, then, that is particularly challenging here if it is an individual investor trying to make individual investments into specific venture capital funds, which is a thing now, right? Like, there are platforms which will provide access to, the current, I won't name certain funds, but, current brand name venture funds. That, just as you think about the minimums of some of those investments, right? Even some of these platforms that are bringing the minimums down to, say, $25,000. If you say, okay, well, if you wanted to build out not just venture exposure, but, to your point, a venture program as an individual, which would imply manager diversification, vintage year diversification, it would get pretty expensive pretty quickly for an individual to try to build that program themselves.
Yeah, and it's one of actually the areas where even institutional investors, there is a real recognition that this oftentimes is the hardest part of the program to build internally. Building a venture program can take a lot of effort and a lot of time. Sometimes we talk a lot about this, there are the best known venture managers, and then there are the best performing venture managers. And they're not always one and the same. Some of the best performing venture managers are smaller in size. And so being able to identify those managers, being able to access those managers, and even for institutional investors, this is the one area of the portfolio that oftentimes is the hardest to build out internally. Because again, there is this likelihood that as an LP, you need to continue to source new managers, continue to source new relationships, that these relationships will top out at a certain size. And so as your total portfolio grows, the amount that you're able to commit to any of those managers may not grow. So you just constantly need to replenish, even if that GP continues to be in the roster of active relationships, even if that GP itself doesn't grow to be so large that you no longer view them as being capable of delivering the type of venture returns that you expect, which is also a challenge in creating venture portfolios. So either the GP grows and perhaps is no longer the fit for the venture program you're trying to build, or the GP doesn't grow, but you grow and now you have more capital you need to put to work, you still need to find new relationships. And so venture in particular is a difficult asset class to scale, a difficult program to scale within these investment portfolios. And so it's just the most challenging to build and scale and continue to. And yet, because the rewards are so potentially high, extraordinarily worthwhile. And that's why you see institutional investors continue to put into these programs and continue to put the effort into these programs. But that's probably a topic for another day. The other thing I wanted to jump back to is what you had alluded to, and I don't want to necessarily pick on any particular manager here, even though I think those of us who have been in this area and in the private markets and had watched what 2020, 2021 brought in terms of, let's call it, newer entrants into the venture space. I think there were certain market participants who were known for being later stage investors who were moving further and further down in terms of how early they were willing to invest in companies, and yet we're still investing in size and still we're creating some distortions, let's put it, into the venture market in 2021 and 2022. And so I think some of those market participants maybe have been, let's call it, fleshed out in some
yeah,
parts.
I could tell you an anecdote. A founder that I advised had raised a round from one of these types of firms that you're referring to, traditionally later stage that was starting to move earlier, and gets a call a month or two after raising this round from the partner at that firm and says, "I just emailed you a term sheet and I wired some money to the bank account." Like, there was no discussion. They just wired the money and sent the term sheet. And the founder called me saying, "What should I do about this?" I said, "Don't touch the money." But I mean, this was what was happening. It was a fintech firm of this era, and the company's doing quite well now. But that was what was going on. I mean, that's, to your point, how different the dynamics were in that era, and how differently some of these investors were behaving. And I think I don't think we're seeing that kind of behavior today, generally, certainly.
I think not, but it really speaks to how I think even as institutional investors, much less individual investors, individual retail investors who might be approaching venture for the first time, there are all of these nuances where, again, these are high-risk markets that folks are investing into, right? And so to the extent that there are ways to diversify the portfolio, ways to make sure that you're creating a long-term program, you're investing programmatically versus simply cherry picking and hoping for the best. There's no average in venture. Well, there is average in venture. You don't want average in venture.
You do not want average in venture.
Average in venture is terrible. And again, not to pick on some of these firms that had been approaching venture with the underwriting of a different asset class almost when they were coming down into the earlier stages of venture. You sort of see how it can really quickly go off the rails if you try to approach early stage venture with a framework that doesn't work for early stage venture, that doesn't take into account the types of risks and outcomes that are more commonly seen in early stage venture.
Well, it was an interesting ride for Brex. Congratulations, obviously, to the founders and all the employees. They built a great company. To your point, Wendy, $5 billion is an incredible outcome, and certainly congrats to the early investors in that business who made a lot of money as well. Looking forward to seeing what this next cycle brings. I am sure there will be more attempted innovation in venture, successful or not, and excited to see what that brings. Thanks for joining us this week on the Investment Office. We'll see you next time.